I know people don't want me to say it, but I think we're in crypto winter. It's likely we fall not just back to fair value, but probably below. Well, why should we fall below? What you have is a savings asset. You don't have a speculative asset, I will argue right now. The chances of making a quick buck on 100,000 from here, I think are pretty low. If you want to save your value and protect it from the ravages of inflation, you should be shifting as much of your savings bucket out of fiat into Bitcoin. But you shouldn't do it all at once. You should do it over time. One thing that isn't stopping is the 6 to 7% devaluation of the currency every single year. And that is the tailwind that will drive the upward trend.
Mark Yusko begins with a surprising admission. He understands why some investors believe the traditional 4-year Bitcoin cycle may be weakening. The argument is simple. Bitcoin has experienced a step function change in demand. Buyers determine price, and with institutional inflows, ETF adoption, and broader acceptance, demand appears stronger and more consistent than ever. But Yusko quickly notes the flaw in the idea that new buyers automatically mean rising prices. Every transaction, he reminds us, has both a buyer and a seller. For price to rise, you don't just need more buyers, you need fewer sellers.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I have empathy for the logic of the 4-year cycle being less relevant because we had a step function change in demand. Because at the end of the day, price is determined by buyers and sellers. And if there's, a lack of buyers, then the price needs to come down to meet that demand. If there's a surfeit of buyers, then the price needs to rise to meet the increased demand. So there is some logic to say, well, we have all this new money going into Bitcoin through the ETFs and institutional adoption. But there's one flaw-ish in that logic, which is, remember, every transaction, there's a buyer and a seller. So for there to be excess demand, you would have to have, fewer sellers for price to rise. Meaning, the hedgers aren't producing as much. That's what the halving does, right? The halving intentionally deflates the number of block rewards. And so if I'm a hedger and I own a mining rig and now I only get 2 block rewards instead of 4, my costs are the same. I need the price to rise, so I'm less likely to sell until the price rises, which is part of the genius of the halving in my mind. The difference now is that for every new incremental buyer that we've seen, there's OGs, right? Wallets that have been inactive suddenly selling. And we're like, oh, that's so terrible. No, it's not. Look, if we meaning the community, want there to be billions and billions of Bitcoin owners and users, it can't all be in the hands of a small number of whales, right? Just mathematically. No, you say, oh, but it could, and the new people just get smaller and smaller increments. Sure. I mean, we can divide into 100 million Satoshis per Bitcoin. That's fine. But there are people who have very, very low cost basis who at some price will say, you know what? Yeah, I'll distribute a little bit. And that's what I will argue that looks like to me. There are 2 types of markets. There's an accumulative market, where there tends to be more new buyers than sellers. And that makes this accumulation pattern is you can be in an accumulation phase. There's also a distribution phase. And distributive markets have a downward cycle to them. And the basic difference is bull markets and bear markets. Bull markets are accumulative, bear markets are distributive. Raoul and others would say, well, that's because you're wrong. Not me, Mark, but people like me who believe in the 4-year cycle. You're wrong because it was never the halving cycle. I can make a pretty cogent argument why I think it is, but they'll say, no, it was always the liquidity cycle. That doesn't really hold water because the liquidity cycle's 7-ish years, not 4. And the 4-year cycle's been pretty observable for a while. And then look, there's other people that say, and I actually believe this, there are people that say, well, you're only looking at 3 instances. That's not enough. That's fair. That's fair. For statistical analysis, 3 observations is definitely not enough. But because the halving is hard-coded, and because we don't see half the miners go bankrupt every 4 years, and because we do see an upward price movement, I think there's some logic. Now, the second thing, the tailwind, is while all of this other stuff's going on, we can debate back and forth, one thing that isn't stopping is the 6 to 7% devaluation of the currency every single year. And that is the tailwind that will drive the upward trend. I think we're in crypto winter. I do. And I know people don't want me to say it, but I think we're in crypto winter. But I don't think it's going to be severe. I just think it's going to be a more mild winter. If your average is 100, okay, what you have is a savings asset. You don't have a speculative asset, I will argue right now. The chances of making a quick buck on 100,000 from here, I think are pretty low. I think the likelihood that we get to, $500,000 in the next cycle, I think is really high. But that's 4+ years away. So what I think people should do, so I was on TV in 2018. And while I was on the show, literally, and I was on the show for like 6 minutes, but while I was on the show, the price went from 10,000 to 8,000. So it was a big move, right? And the host says, well, what should we do? I'm like, we should buy it. She says, well, you would always say that. And I'm like, yeah, I would. Buy it today, buy it tomorrow, buy it next week, buy it next month. Don't buy it all at once. Figure out how much of your portfolio you want to own. Buy some today, buy some next week, some next month, the month after, and keep accumulating your savings bucket, right? Don't put the money that you need to pay the bills into a volatile asset. Stocks, bonds, anything. I mean, that you need that to be in money that you can spend. But if you want to save your value and protect it from the ravages of inflation, you should be shifting as much of your savings bucket out of fiat into Bitcoin. But you shouldn't do it all at once. You should do it over time.
Yusko emphasizes that Bitcoin is literally a network, nodes, miners, and participants securing a decentralized blockchain. Like all networks, its value can be modeled mathematically. He references Tim Peterson's Metcalfe's Law valuation model, which estimates Bitcoin's fair value today at around $91,000, $92,000. In 2017, fair value was $10K, but price hit $20K before correcting Gore. In 2021, fair value was $33K, but price hit $69 before collapsing. In 2025, fair value is $91, but the peak reached only $125. This cycle did not produce the explosive 2x fair value blow-off top we saw previously. Because price didn't overshoot dramatically, Yusko believes the correction will also be more muted, but he does expect price to fall below fair value as it has in every past cycle.
The nice thing about Bitcoin is it's a network. right? It's physically, literally and physically a network. It's a network of nodes that secure a blockchain that enables Bitcoin to be a better form of money going forward. And therefore we can measure all the elements of a network just like any network. And I have a buddy in the industry, Tim Peterson, who runs a firm called N Squared Crypto, and he's N Squared Value on Twitter. And he's been tracking this model, this Metcalfe's Law model, for years. And based on that calculation, he comes up with a fair value of the Bitcoin network, the Bitcoin blockchain network, at around $91,000 or $92,000 today. And what's interesting is if you look at history, in 2017, that value was 10,000. Now, if you remember, we went from 10,000 in November to 20,000 in December. So we got 2 times fair value. And then we had a big correction and we fell well below fair value until the next bull market started. Then in 2021, fair value had gone up to about 33K, but we went all the way up to 69K in November of 21. And then we had a big correction. So here we are in 2025, same 4-year cycle, fair value at 91. We only got up to 125, 126. We didn't get a full 100% higher. We never hit that 170, 180 that people were calling for. And so I will argue that the correction will be more muted because of that. Because, it's likely we fall not just back to fair value, but probably below. Well, why should we fall below? Well, corrections occur when people who bought for, we'll say, less than ideal reasons. Like if you think about the cycle of any investment, when the price is below the fair value, right? And if that's a stock, it's the discounted stream of future cash flows. If that were a bond, it would be the certainty you have with the payment of interest. Whatever it is, if the price is equal to fair value, you're probably agnostic as to whether to buy it or not. If the price is below fair value, investors will buy to try to close that gap. Well, as the price starts to move, traders are drawn to it because traders don't really care about fair value. They just want movement. They want to go long or they want to go short, and they trade. Well, as the price starts to get above fair value, hedgers emerge. Well, what's a hedger? A hedger is someone who owns a commodity, whether it be oil or gold or Bitcoin. Bitcoin's classified as a commodity, that produce it. And they now say, well, wait a minute, if the fair value is here and I can sell it at a price above fair value, well, I know I'm going to produce it tomorrow, so I'll just sell it in the futures market. And if you can sell an asset in the futures market, you need someone to take the opposite side. Those are called speculators. So speculators are taking the opposite side of a hedger. Well, then that increases the price. Now, when the price starts to really get higher above fair value, now the gamblers come in. And the gamblers not only buy the asset because it's moving, but they use leverage. And leverage is not evil in and of itself, but it's the amount of leverage relative to the volatility of an asset. So what happens is as those gamblers push the price to too high a level, it snaps, they get liquidated, the price starts to fall. And as the price starts to head towards fair value, the traders get nervous, so they sell, and the price gets down. The hedgers can't sell because now the price is below fair value, so they'll just hold it until the price goes back up. And then the long-term investors wait until the price gets down here and they start buying again. So you get this natural cycle.
Mark Yusko's analysis brings clarity to a market often clouded by emotion, hype, and short-term thinking. Whether you follow liquidity cycles, halving cycles, or pure network value models, the conclusion converges. Bitcoin continues to mature into a global savings technology. Its long-term trajectory is upward, driven by scarcity, expanding adoption, and the ongoing erosion of fiat value. But cycles matter. Investor psychology matters, and understanding the difference between fair value and market price is crucial to navigating crypto's volatility with confidence. For Yusko, the roadmap is simple. Accumulate patiently, avoid leverage, understand the network, and zoom out. Bitcoin's destination hasn't changed, only the journey has become smoother and more widely participated in.